welcome to Chase ABE Equity, Unlocking the Secrets to Long-Term Value for Your Business. Business valuation is one of the top strategies for understanding the value of your company in terms of assets and net revenue. Business valuation is one of the top strategies for understanding the value of your company altogether. Now, today we're going to discuss how valuation is determined, and we're simply going to use your company's balance sheet. We'll show you how to subtract the liabilities from your company's assets, and that provides you with the net asset value for your company. Now, if you were to liquidate your remaining assets, that final amount is the total amount of money that will be returned to you or to your shareholders, provided that you've satisfied all your debts and that all of your debts were paid off and your assets were all liquidated. Now, understanding the true value of your business provides you with opportunities to communicate its overall health and the well-being of your company, as well as planning your exit strategy. That's right. So comprehending your company's worth would positively impact your financial options down the road. For example, you could buy another company, you could vacation for the rest of your life, or you could actually know when you could sell your company. Now, before we get started, I want to just go ahead and give you all a quick welcome on behalf of our president, Ron Busby, our board, our chambers, and our staff. I want to thank you all for attending. You're probably wondering who I am. I'm Philip W. Dunn, the program manager and chamber engagement leader with the U.S. Black Chambers, Inc., affectionately known as the global voice of Black businesses. Now, we represent over 160 Black chambers of commerce and small businesses across the United States, and we're founded on 5 pillars of service. They are advocacy, access to capital, contracting, entrepreneurial training, and chamber development. Now, this webinar that you're watching is crafted in collaboration with our chambers of commerce, providing technical assistance and resources to businesses across the United States with the U.S. Small Business Administration Communities Navigator Pilot Program. Now, we want to thank them for their assistance in developing and sharing this program. Our team at USBC, as well as our 20 Navigator chambers, we look forward to being a resource for you and to your business as you navigate through this journey. Now, before I introduce today's guest, I'd like to encourage you all to participate in the chat. We'd like to call it a fireside chat by dropping your questions into the chat in the Q&A in response to our discussion. And we're also going to conduct some polling throughout this webinar, just to understand where you are in your journey toward business equity and in generating long-term value. Now, today, without further ado, we welcome our very special guest, Mr. Johnny Charles. He is a senior business consultant for JP Morgan Chase. Johnny holds an MBA from Brandeis University in Management and Social Policy. That's important, social policy, where he focused his studies on revitalizing local, state, and city economic development centers by way of new market tax credits. So Johnny has a lot of great experience, knowledge, and wisdom he's going to share with us. Johnny also holds a Bachelor of Arts in Communications with a focus on journalism and business management. So very well-studied expert that we're going to have here today. Now, with over 10 years of experience in the financial services industry, Johnny has held a number of positions centered on economic development and restoration, including his position as the Director of Economic Development at Dorchester Bay Economic Development Corporation. Now, prior to this role, Johnny served as the first managing director of the Boston Ujima Project. So remember that word, Ujima. He currently serves on the board of Southeastern Economic Development Corporation, or SEED. So with that, we have 4 questions that will give Johnny a sense of who we are in the audience and what stage of business development that we're in. But before we do that, we're going to turn it over to Johnny to tell us a little bit more about himself. Take it away, Johnny.
Well, thank you, Phil. I appreciate you. And thank you for the SBA for giving me the opportunity to talk about valuation, small business growth in general. I like to think a lot of our work here as senior business consultants at JP Morgan Chase are really about behavior change and adopting positive behavior that are directed at building wealth, both individually and ultimately from a community perspective. I won't take up too much time in introducing myself. I feel like we've said a lot, so thank you for reading off the bio. But I'd like to think that for me, the most important aspects of myself is I'm a father, I'm a partner, I'm a community member, family member, friend, and I like to think a decent human being. So thanks for having me here. And without further ado, I don't want to hold up the agenda for too long. I'd rather us get started on the poll, and then we'll dive right in. But thank you again.
All right. Thank you so much for that, Johnny. And we do have these questions here that we'd like for you to answer for all the folks in the audience. The first question, do you have employees that are independent contractors? This is a yes or no question. Make sure that you respond to that. Second question is, are you looking to hire employees? Yes or no? And the third question, do you have consistent revenue for the past 12 months? Yes or no? We do know that some folks have contracts that are short duration contracts, 3 to 6 months, 9 months. It sometimes doesn't extend beyond the duration of the initial contract. We want to make sure that we understand that. And then lastly, are you looking to hire any one of these combination of folks, independent contractors, laborers, bookkeepers, mid-level managers? Let's get a good sense of who we have in our audience. Johnny, I wish we had some Jeopardy music to play while everybody was taking the poll, but we don't. So I'm looking forward to seeing what these responses are going to be after the poll has been responded.
Same here. I was almost tempted to sing the Jeopardy music theme song myself and just hum it along, but I won't embarrass myself in that way.
We don't want to lose anybody, Johnny. We don't want we don't want them to turn away. All right. Wow. Okay. So we're presenting the results of the poll, and it looks like we are running neck and neck here. Johnny, what's your take on these poll responses?
Seems like just about half or more folks have at least do a lot of business with independent contractors or have independent contractors as employees. Over half, about 60% of folks here are looking to hire, which is interesting, considering market forces and the economy where we are. Majority of bigger firms are not looking to hire. So hearing from folks that they're looking to hire is interesting. And so we'll probably get to the bottom of some of that. And in terms of hiring, no one is really looking forward to hiring long-term or full-time equivalents in terms of full-time folks offering benefits. It looks like majority of folks, when they say they want to, they're looking to hire, it looks like they're looking to hire contractors. So that can be indicative of short-term opportunities or the way that we're thinking strategically around balance sheet and long-term wealth. So it looks pretty, even in terms of what I see day to day. So it's a good place to start.
We got a really good basic understanding of who's in the audience. And there's a couple of questions that we developed for Johnny, where we wanted to know a little bit more about why this is important for us as business owners. Now, for us, we wanted to know, and this is a question for you, Johnny, and really help explain this to our audience. Why is it important to know my company, my business's valuation, and how can that help me in my long-term strategy?
Perfect. Thank you for asking the question. It's a great question. And before I do that, I'm going to do some house cleaning really quickly, and then I'll jump right in. We're about 20 minutes in, so I just want to cover a few things. So the three things and objectives that I hope folks walk away with are really kind of understanding that financial statements are really, really important. And we'll review that really quickly, both personally and professionally. Improving yourself in terms of being a continuous ongoing learner because the most important investment in your company is going to be you. And so you have to really kind of put the best step forward and really making sure that you're investing in yourself and refining who you are as an investment, because before anyone invests in your company, they're investing in you. And so for the most part, really remind yourself of that on a day-to-day basis. And then the third point is really making sure that no matter what you do day in, day out, that there's a strategy that you're holding yourself to. So again, making sure that we all understand financial statements, and if you don't, really making the time to do so. It's not enough to put together numbers and then submit it. Really making sure that you hold your CPA or whoever it is accountable. It's really helping you learn what those numbers mean, improving yourself as an investment, and then really making sure that you're sticking to strategy. So for the purpose of this fireside chat and answering some of these questions, I kind of want to just add a little bit visualization to some of these responses. So we've prepared a couple of things in order for us to kind of walk through what this looks like. So bear with us. We're going to transition with some shared screen and then some not shared screen in order really kind of hopefully that folks walk away conceptualizing what's being said and some of the lessons that we're offering here. So, and as we do that, I will share my screen, and I won't really spend too much time. Let me do this again. So in terms of really understanding and why valuations are important, before we do that, it's really, really important that we understand how to read your core financial statements. And in particular, for this particular exercise, we're looking at the balance sheet. And the balance sheet allows us to really kind of take a look at who you are, your organization, and the total value of it. And there are a few things that go into what that value looks like. But before we do anything whatsoever, I just want to make sure that, when you're on Zoom, certain windows are open. So I'm going to move things back and forth so we don't have too much of a distraction. All right, here we go. So the balance sheet, and I know folks, you hear the balance sheet equation all the time, that your liabilities and stakeholders' equity equal your assets. So I want to point to a few things. So when we think about the balance sheet, we want to make sure that we understand what our total assets are. And those assets are a combination of some short-term and some long-term assets. What does inventory look like? Accounts receivable, which is money owed to you that you're trying to collect. What does equipment look like? Those are all assets. And then we move down to liabilities and really understanding what do we owe? Whether it's a loan, a short-term, long-term loan, or bills that you're actually paying in short-term and long-term. And I say short and long because those are all captured on the balance sheet. And we want to make sure that the two equal, from the assets and total liabilities and equity, that they both equal. So anytime that you're getting a statement, you want to make sure that those total assets and total liability and shareholders' equity equal out to each other. And this plays out here on this side. So I'm gonna move this circle here. And I thought I would use this circle as a cursor just to kind of really make sure that as I'm saying things, people can actually see it for what it is. So this is a made up company. So we're using this sheet here called XYZ Sample Company as an example to really kind of illustrate these numbers. And we just thought to do this just to make it easier versus just having slides. This here is just produced by myself. So I want to just really, as a disclaimer, this is not a JP Morgan Chase product. Although I'm representing JP Morgan Chase, this is not something that JP Morgan just really put together and offer clients. This is for the purpose of learning and experimental learning, and that's it. And so I walk through a lot of my small business clients when we talk about valuation, when we talk about balance sheets, when we talk about cash flow. And just to name, we're looking at, we want to consider 3 basic financial statements. Today, we're really kind of just only talking about the balance sheet, but we're talking about the balance sheet, the cash flow statement, and the profit and loss, also known as the income statement. And for the purpose of time, we're only going to really refer to the balance sheet. But really understanding and knowing what the valuation is and the total amount of the value of your company really gives off and allows us to really understand, okay, how much can I sell it for? So again, and now that would be expressed in what is the purchase price of your company. And I can go into more details, but let me, I'm going to just give you some space and time, Phil, to ask some more questions. I'm going to leave this up just to kind of help answer a few things.
Thanks for that, Johnny. So, as business owners, we oftentimes get caught up in just running the business, making sure that our processes are working, making sure our customers are happy. But we actually need to spend some really good quality time understanding the financials, our assets, our liabilities, how much we own, how much others own in the company. But from what I can tell, there's probably some strategies that we all need to follow in order to make sure that our balance sheet, our income statement, all of that is healthy. So, can you tell us about a couple of good best practices or best strategies to manage our business towards financial health?
So I think, and let me just stop sharing screen for now. Um, s- I would start with your business is a living, breathing organization, and I was going to say just organ. Um, and I think the way we should think about our business is somewhat of a person, right? And so when you think of that, when you break it down to the individual level, you as a person have a balance sheet. And if this is kind of a new concept for you, I would say really hold on to that and really think about that a little bit more. You have assets, you have liabilities. There's also equity in what you own and what you have, and really taking account for what that is where we start. And I think oftentimes business owners go into business really not understanding these concepts. And so therefore there isn't a practice of making sure these things are kind of upheld well. And so we miss the mark on things. So we're relearning or unlearning certain practices. So for example, as a person, if you're not already taking a look at your credit card statements, if it's one of those things that, hey, I would rather see that, would rather not look at that until, next month, I'll pay it down when I can. Understand that those are same practices and behaviors that's going into your business. It's only a matter of time before those bad habits actually seep into your practices for your business. And so let's bring it back. So if you have good general practices personally, it's only natural that you do the same for your business. And so if you know for a fact, hey, I'm really tough when it comes to, I'm really bad at credit, I don't pay my bills on time, you might have to delegate or seek out additional support or outsource what that support looks like. Okay, well, when it comes to bookkeeping and thinking about your financials, you might not be the best at that, right? So you might want to delegate as in terms of what that looks like. So rather than go into the balance sheet and talk about goodwill and talk about the multiples, those things are really important to understand. But before we understand those things, we also need to understand how in the world do we manage our balance sheet on a day-to-day basis for ourselves in order really to do the same thing for your organization.
No, I appreciate that. Some of the things that I captured, definitely understand and study your financials, develop good practices around reviewing your financial information, your transactions, learn how to delegate some of these tasks for those tasks that we don't have a full understanding of. Make sure that we learn how to delegate. So there are a lot of different strategies that you can take in order to move towards financial health. These are just a few, and I'm sure that Johnny will be sharing even more as we move throughout this presentation. Now, the other thing, Johnny, when I think about like a business, anytime I want to, uh, accomplish a task in business, I can outsource, like you mentioned, or delegate a specific task to either an employee or I can hire a third party. Now, when it comes to business, if I want to grow and I want to maybe grow by acquisition, or if I want to, divest and sell, then I have to have some type of exit strategy. Now, I don't necessarily know who these people are. Who are the professionals that can help me with that? Who are the professionals that can advise me with planning an acquisition or an exit strategy?
Yeah, and I think that varies. Obviously, we can think about individuals that represent venture capital firms. There are specific websites, and Unfortunately, I represent a pretty large organization, so I can't necessarily say who those are or give examples. I can only speak from a generalization perspective, right? And so as a senior business consultant, what I do is I work with clients one-on-one, and we sit down, we have these conversations all the time. And we're all across the nation. So at this point, I think we're about 52 consultants across the country. I'm located here in the Boston market, currently in Jamaica Plain of Boston, the city of Boston. And so you can find me oftentimes in the branches. But for the most part, and in those branches, I'm usually having meetings virtually one-on-one with clients, or I'm meeting them at their particular sites, and we're talking a little bit more about this, right? And so I would say that there are specific websites that offer this, and that's just a Google away. And my contact information will be up a little later at the end of this, the conclusion of this presentation and conversation. So you can feel free to, send me a message, and I can point you to the right direction. So I would say that those vary, but one of the things that we work on as business consultants, among a couple of different, and so when we work with small businesses, we work in the areas of operations, navigating cash flow, access to capital, building out trusted advisors, to your point related to this question, and business development. And building out trusted advisors, this would be a question that come up, and then I'd say, hey, let me send you 3 to 5 different individuals that can point you in the right direction. You should always have a CPA. You should always have a strategist, in any particular who has experience. You should always have a legal counsel. And all of those, particularly in your circle, can guide you in terms of what that looks like. When we think about business strategy and combining this piece about selling, let me share screen one more time. Let's take a look at a few things. Now, when you're having this conversation around selling, leveraging, and really what it takes, it's really important that we understand what it means to have this term called EBITDA, right? So earnings before interest, taxes, depreciation, and amortization. And this is pretty much, we've accounted for revenue, we've accounted for cost of goods sold, we've accounted for all expenses, and we've subtracted that gross profit and expenses. And the next tier is we're including depreciation, we're including taxes, and that would give you the net. But before we get to the net, we are gross, and we're subtracting the gross profit from your expenses, so your general expenses. And this would give us the EBITDA. So the EBITDA pretty much is, what is that operational income? And this is a good practice to do just for your own personal self and household. You as a person have an EBITDA. And so there's a total number that's attached to that for yourself. So, and I'm gonna refer back to the individual a lot, because if we're thinking about behavior change, and we're thinking about creating wealth, long-term wealth, these are the practices that are needed. And I won't go too much into that. So EBITDA, in terms of what, when you want to exit, what's your exit year? And this is more of a target. So when we think about, so I'll walk through some of this terminology, and I'll try not to take too much time. And when we think about terminal value, for the sake of this conversation, we're only just referring to you as an enterprise. So this is the enterprise value. So, and when we say exit multiple, you'll hear multiples a lot, because once you get into this conversation around selling, it really is, how much are we making from this investment in terms of the buyer of your business? And the multiples is, we're looking at 6 times what that amount is. So if your business, in another sheet, I think further up, we have a total amount. We have here, and I'll drop through. I'm just going to uncollapse a few things. We have, for us, we're targeting, and I'm just doing it for the sake of this example. We're saying, okay, total assets at 150,000 roughly. We're saying that this company is worth around that number. But what we want to sell it for, in order for us to make a profit, we want to start off at 240,000. And then here we're going into how much cash on hand and how much debt are we subtracting for that. And then the actual number at this point is we're playing with terminal equity value. So now we're saying that the amount after accounting for the discounts, we're at 239,694. And let me know if I'm going too fast here. And at some point you want to factor in present value, net present value equations. And then I'll stop here and go over to levered and unlevered. So internal rate of return is literally really kind of, I think oftentimes we think about, all right, what's the return on the investment? That's one calculation. Internal rate of return is oftentimes used in sense when we combine assets, when we combine all assets, liquidated assets, all version of assets, and the frequency in which that we're earning a return from those assets, that gives us an internal rate of return. That is extremely important when we think about selling and leverage. And so unlevered is really before you factor in the debt. Levered is with debt. So you are producing a rate of return of 16% when levered is at 25.7%. And again, these are for examples. And I want to, and when we think about, so what I want to do is make sure that we're not just going to just throw language and say, hey, we are selling and we want to talk about what it means to exit out. Well, in order to do this, it's really important that we're being strategic, right? So like, where is the value of your business now? And what you need to understand from a balance sheet, from all financial statement perspective, and then go, all right, great. What are we forecasting this to be within the next couple of years? When are we ready to sell? Hint, when are we ready to exit? I hope that answers some of the questions well, Phil. And I'm going to stop.
Yes, it does. So when I think about EBITDA, this number might be an indicator for me to say, okay, I'm at a good place, I'm ready to sell.
Yep.
Or it might be an indicator to say, okay, what happens if we double production or if we increase our sales by 20%? What does that bottom line number look like? Is that one way that I can use EBITDA to kind of help me in pushing in order to increase the value?
Yes, absolutely. You can use, so EBITDA is really kind of the barometer, it's the proxy, right? It's what you're earning off of operations before you have this, before you are paying the additional cost of business, which is taxation, interest, amortization. And I won't go in too much into detail about each of those pieces because we just don't have the time. And right. But for the sake of time, all of those matter. So when you have your EBITDA, you want to say, okay, great, this is what we're earning based off after we account for our expenses. Now that we know that, we want to multiply this. We want to, because the beauty of all this is saying how fast can we grow and where do we want to go? Because all of this is about planning and strategy and implementing that. Now you're not just providing information to financial guru by way of CPA or financial analyst. You are literally talking language and providing the story. And I think a lot of us have a story attached to our business. It's a compelling story. I started off cooking from home. My kids and my mom said I'm a great cook. I then got into a shared space, shared kitchen. I started producing. Now I'm doing X amount of pounds of food a month. You know what? We're going to have a food truck. We go from the food truck. Now we're opening a restaurant. We open the restaurant. Although we have a lot of high turnover, the food is great. We're having great results. I am tired. 10 years in, I don't want to do this. The kids don't want to take over the business. So do we convert it? Do we sell? Before we get there, we know that we're getting tired. We know that we want to exit. We know that we haven't planned for retirement just yet. Now, let's bring in our sound of trusted advisors, our CPA, our legal counsel. And now we want to have a conversation about here's where EBITDA is. Here's the growth of it. Here's the internal rate of return. Now, let's plan out the next 10 years. What does that look like? Do I delegate until it's time to exit? where do we go? And that's how we have those conversations.
Awesome, awesome. Now, my next question, it kind of, you know, kind of talks about those four components there: the interest, taxes, depreciation, amortization, because those we don't always control those factors, right?
Right.
Uh, and so I wonder, if I'm in business, how can I best position my business given those four factors to produce the highest rate of return for a merger or for an IPO or investor capital when I'm ready to sell it? Given those four factors, how can I, really make sure to best position my business?
Now, with those four factors, we know that they're not necessarily fixed. And so what in the lending game, you
Yeah.
typically we phrase this as a stress test. And you know, there are other ways that we can frame this, right? Like uh, I've heard other folks when I talk to my friends, when we talk about relationships, when we think about adversity, we go, you know, we're battle tested. We're ready to catch that next hurdle, that next adversity. Um, you, the way that we frame this in business is it's a two-part conversation, right? It's where do we want to go, and then it's on paper, what does the stress test tell us? So let's be a little bit more detailed about what the stress test is. Whenever you go out for money, when you go out for lending, a lot of your revenue, your collateral, your assets are discounted. And then they say, well, I'm going to reduce this at 50%. How well do they do? And guess what they use to measure how well you do? The EBITDA. So now they're using the EBITDA, and then they put a whole bunch of variables, tax rate. Uh, Typically, in my projections, I usually put in consumer price index, the change of inflation from month to month. All those things matter because there's a cost to every decision that you make, and I think sometimes we forget that. And so, just as just want to take a look at these here. So for me, and I'm gonna, because we're in this framing of selling and exit, um, when I think about your example and how things change and the rate of which they change, you want to test against that. So I do a lot of projections. So oftentimes people come to me and they say, Johnny, I I want to get lending, or I want to get a credit card, or I want to buy a truck. Then I go, that's great. Let's put the numbers to the test. And I do the same thing for myself personally. And when I do, I'm like, man, I can't afford nothing. But I'm exactly. But at the end of the day, you want purchase power. And so sometimes the way you test purchase power is by you want to do projections. So, for for XYZ company, we're saying tax rate is at 30%. We don't know if that's the case, but we're going to put that in there because we want to see how well the numbers do. And then you want to fill it in with actual numbers as you go along, if you're managing the balance sheet, if you're managing performance. And oftentimes, so I'm gonna take a sip of water. That's me getting excited and dry all at the same time. Um, so oftentimes what we say is, all right, great. How well do they do against these independent variables that go up and down from year to year, month to month? And so if you're thinking about a buyout or you're thinking about selling, what you want to think about is the fair market value. And for me, what we go here and we say, all right, cash. We can, and you can play around with cash a little bit depending on who you talk to, because cash dollar yesterday is not the same as dollar tomorrow. But for here, we say cash is at 57,000. We're not discounting for this. Accounts receivable is at 4,000, and then oftentimes what happens is the individual will take a look at what's in accounts receivable and what's the probability of you getting that back. So here I'm just gonna, give an educated guess and say 500 of that is not going to carry over, or at least you're not going to retain. Inventory at 6,000, about 4,800 will be the amount you retain. This all adds into your fair value, and here's the adjustment. And then this goes into your purchase price allocation. Now, the net book value of your assets is really your combined value, your combined assets. I didn't put anything here just for the sake of practice, but total purchase price at 190,000 and then we have this piece called goodwill. Now, if this seems overwhelming as I'm explaining it, it should feel that way. What I'm hoping is that people go, "Hey, I'm understanding this term. I've heard it before, and I'm finally conceptualizing where it fits and how it is." Great. But if majority of this information is like, "Well, this is a lot," good, because that means it's going to require some time for you to understand. And in that time, if you're investing in yourself, then you are becoming that better and that better of an investment for the person that's looking to buy your company. So, and we can talk about goodwill, but these pieces add up to what goodwill is, which is both tangible and intangible assets. And when we think about selling, goodwill is going to be really important, because sometimes goodwill can be expressed by way of your brand. It could be expressed by how much sweat equity is put into the community. And sometimes it can be expressed by you've done really great marketing, and depending on your industry, this will allocate towards that. People will pay for that. And there's some companies that don't produce revenue well, but their goodwill is really, really, really good, and it's worth investing in them, depending on what we're talking about. And most of the time, we're talking about tech companies. So, I mean, I'm gonna pull back, and I'll stop there, and I'll stop sharing.
No, if you could leave that up, John, because now you've given me some ideas as a business, person on how to actually position my business for success. Manage cash.
Right.
Make sure that I'm managing my cash and I'm being diligent about, the cash that I have on hand, and have good controls around it. My accounts receivable, making sure that I have good policies in place to call and collect on those accounts receivable, or be prepared to factor, or work out some kind of a way to ensure that I collect on those receivables. My inventory, making sure that I'm getting that out the door, pushing that out the door, considering all other opportunities to move the inventory. PP&E. Maybe I need to start purchasing equipment with a longer life, maybe shorter life. I don't know what that impact is on EBITDA, but these are the four things that I know I can manage if I'm strictly a business person. Now, the other stuff that you mentioned, I want to leave that to my accountant, or leave that to you,
Exactly.
Johnny. But these are the things that I'm going to see and put my hands on in my day-to-day operations of running a business, right?
Yeah, and if I could put a plug in, and I'd be wrong if I did not, so I don't want to be remiss. But a lot of this stuff outside of your advisors, which should include your advisors actually, should come down to your banking. So if your banking relationship is only that you are depositing and then you are withdrawing and you're out of there, I'll tell you now that it doesn't work. Now, obviously, I'm biased. I'm telling you to go to Chase, obviously, so I'm going to be explicit about that. But it is your job to do the due diligence to figure out what banking works for you, right? And when we think about what works for you, cash management, what does that look like from a banking perspective? Making sure that you have the best account and best resources where you're not losing money on fees. And that's what that looks like once you are over a threshold here at JP Morgan Chase and you have a private client advisor. What does that look like? And now you're talking about where does the cash go for long time investment, right? And where does that come from? Does it go into treasury? Where is that in the banking world? Accounts receivable, making sure that you're collecting payables and make sure you're collecting receivables on time. Because you need a banking relationship and software that allows you to do all those things all in one. And forgive me for the selfish plug. I apologize, but I wouldn't be doing my job if I didn't tell you it really comes down to your banking relationships. And for those entrepreneurs that are out there that has you are at one bank and you got reserves in one from the business. You're at another bank and it's kind of cash management or taxes. I'll tell you, they have to all align. And so whether it requires you transitioning in and out of a bank relationship, it's going to be. I will say that it's important that you do so. You want one bank. You want one bank that does it all. So therefore, it lessens the stress and the worry that you have to go through and experience. And personally, I truly believe that And that's, that doesn't come with a selfless plug. I do truly believe that. And it is okay to have different relationships elsewhere, but when you think about your business, do it justice and make sure that you're under the same roof. And a lot of these pieces can be discussed in detail with the right banker and the right bank.
And I appreciate you for being taking that selfish plug, because I agree. You want to be able to offset your accounts, and I think you, like you said, you have to be under the same roof, so to speak, when doing that. Now, Johnny, there's really one more question I have before we go to the audience, and I like to think about the timing of business cycles. You have economic cycles. Uh, if I'm a business owner and I'm looking to sell, obviously I can't sell tomorrow. Uh, what should I look for from a timing perspective when planning a strategy to sell, and or even to buy? What's the best time to execute? What should I look for in taking one of those transactions?
So for me, there's a couple of things. One, you want to take a look at operations. Does the business survive without you? And if it doesn't, then we've got a problem. So let's not think about time. Let's think about let's plug that in. Can the business run without you? And I'm not saying that you don't have to be there, but does it in terms of management, insight, perspective? But if the place can't run without your oversight and management, the day-to-day, meaning your physical presence, then you've got to improve operations, making sure that you have management that buy in to the culture and to where the company is going. Number two, I think when I think about timing, I'm thinking about externalities, right? So I'm thinking about recession, inflation, really paying attention to the market from the perspective of cost savings. And currently, right now, I think there was a report released around interest rates for mortgages from, I think, a few percentage points. It went down. I think it was from 7.6 to 7.0, 7.1. But feel free to follow up with those numbers. But those things are really important because they have an implication on your business. So making sure that you are in the know, not just for current events and affairs, but making sure that you understand where the market is, because interest rates matter. You are borrowing somehow, some way. The amount it costs for you to buy supplies, that's predicated on interest rates. That's predicated on a whole bunch of things, but you want to think about the rates. So if the rates are too high, it depends. It depends on the strategy. So it could, if the rates are high enough, then it's probably a good time to sell. You're probably going to earn a lot from it because whoever. But if that other person needs to borrow that money in order to buy the company, it may be hard. So it really, for me, it's the timing perspective is there's an externality focus, which is around the market, the interest rates, and the other piece where you want to start off is operations, and how long it's going to take you to get operations to a place where you have like kind of not a, I want to be clear when I say this, you want to have like a franchise model, not necessarily launching a franchise, but from the perspective of can things run smoothly without you being physically there.
Mhm. And then, there's always the option, when you do sell, to stay on and run and manage for a couple of extra dollars, I like to say, the business until things can run on their own. So I definitely like that. Now, Johnny, I don't want to monopolize all of your time with just my questions. I know that we do have a couple of other questions in the audience. I'm going to look to the Q&A to see what has come in. First of all, David Payton says, great explanation of EBITDA. And I know I took a couple of accounting courses back in the day, and with yours, I was able to stay engaged and follow it all the way through to the bottom line. So I definitely appreciate that, and I agree with David Payton on that. Mickey Williams asks, how does all of this work for service-based businesses? If you're not pushing a product 12 months out of the year, but you provide services, maybe it's throughout the year, maybe it's a couple of months out of the year. How does all of this work for service-based business?
Well, we would have to talk individually one-on-one, but what you're looking at is less inventory, but it's more branding and goodwill in terms of the intangible assets that you get to measure. And what I would recommend is taking a look at the numbers from a service perspective, and seeing what is your goal, how far do you want to grow, and then at that point we want to push it to a subject matter expert, because not all businesses are fit the same. As much as we have NAICS codes that describe your industry, even NAICS codes don't solve it when we think about industry barometers and benchmarks. So that would require context, and it would require some nuance in terms of what kind of service, where do you serve, what does that look like, what does traffic look like, what is the demand on that particular service. And so there's a lot of intangible things there that I would have to take a look at, and we can talk offline. But I would say that measuring goodwill in that company would take precedent over valuation by way of inventory and assets.
Right. And so also, if there's existing contracts and agreements in place that have to be considered, those have to be considered as well, right?
Right. And that would, from a numerical perspective, that would account for towards assets. And that's why goodwill is a better measure, because the value of those contracts by way of number, and is it anchor institutions, right? By way of higher education. Is it a 4-year institution that you have those relationships with? Is it another chiropractic service somewhere? Is it professional services? So that's why the nuance and the context of that is important.
Okay. All right. And thanks for that, Dave, or not David. That was from Mickey. Sorry about that. David was the one that was talking about the EBITDA. So I wonder, Johnny, if you could tell us a little bit more about the actual management of business, really preparing to sell. If I had 30 days to make sure that my business was right, to make sure that it could run without my, being there, what other things do I need to do in order to make sure that that business sell closes in 30 days?
First of all, I would advise against that if you've got 30 days. Absolutely not. I'm also looking at time, so I don't know if you want to go a little over, Phil. I don't know if it's a hard stop at 3. But for the full answer for that, we don't have enough time.
Yes.
So number one, I'd advise against it. That's like saying we're going to close on a home and a mortgage in 30 days, and you're just now collecting documents. We can aim to do that, but as you know, sometimes that's not a guarantee. And sometimes that drags on. And if we go past the 30 days, those documents are required again. Because keep in mind, the balance sheet, the income statement is a snapshot in time. So timing is important. So you want to make sure that if you're having to close in 30 days on a business sale, I would urge and encourage that you extend that term. So at this point, I would say it all depends on the terms that are being negotiated on, and that will predicate and dictate what your next step is. But aside from that, that's not a quick 2-minute response.
That's why you're the consultant, and we're here to learn from you. So, Johnny Charles, I want to thank you, and I want to thank everyone for attending Chase ABE's Equity, Unlocking the Secrets to Long-Term Value. Now, this was all possible through our work with the SBA Community Navigator Pilot Program, funded in part through a grant with the U.S. Small Business Administration. Now, a tremendous thank you to Mr. Johnny Charles, our senior business consultant with Chase, for sharing his wisdom with us today. We do intend to bring Johnny Charles back to share more information with our audience. And I also want to thank our Community Navigator Chambers for advocating for Black businesses all throughout the year, and to you, our viewers, for sharing in this discussion. Now, USBC introduced a platform called Buy Black, which is the only Black certification program with a business directory, providing businesses that certify access to private and public procurement opportunities. We provide highlights and other benefits as well. But this online program can help to prepare you for the contracting space as a documents preparation guide. So certify today by visiting usblackchambers.org/certification. Now, we also want to invite you to give us your feedback on today's session. Just scan the QR code or type in surveymonkey.com/R/BizFuture. Now, join us for some upcoming events that are going to be taking place. You can visit usblackchambers.org/webinars to register for topics such as Friday's live webinar about the Buy Black platform for Black-owned businesses. Or Tuesday, November 14th, we have Increase Your Sales with Google Tool. Now, this workshop is going to be most beneficial to small business owners and entrepreneurs who want to drive sales in their company. Also, Thursday, November 30th, we're going to the next level using hiring and cash flow strategies to succeed. Now, we also encourage you to follow us on social media by following us at usblackchambers.org. And if today's forum prompted additional questions and interest, please feel free to contact us at programs@usblackchambers.org. I want to thank you all for joining us today. If you are observing the holiday tomorrow, Veterans Day, we salute all of our veterans and we appreciate them for their service. And then also we want to wish you in advance happy Thanksgiving and Soul holiday that you hopefully will be celebrating at the end of November. Johnny Charles, we thank you, sir. We thank you for your time. We thank you for your information. And we look forward to having you back in the future.
You all, thank you.